Welcome back, everyone. The It's called X now. I almost said Twitter Spaces. X Spaces back. We're on the road today. New York City. New York City with the wife to see Beyonce. So, being a very good husband. I mean, I would say this whole week it's been a really good week for her. I went to Barbie the other night. Oh, pretty good movie. Well, I fall asleep early, and the trend in this movie is so strong. It's bigger than T Swift. Yeah, I lived through the T Swift phenomenon, and now they picked up where they left off with Barbie, and it's all sold out. And we got a 10 p.m. Second row. I slept through the first half, but the second half was pretty good. It was funny. So, been a interesting week doing what she likes to do. Then I recorded with Niels and Alan yesterday. They let me come back on to talk about a lot of the questions they asked the CTA SocGen 20. I'm not a SocGen 20, but they were kind enough to let me come on and talk, and it was very fun, and we talked a lot about the same issues and gave the same answers, how that goes. And but it was just too much. They asked me too many questions, and I just could not get my answers out. I was just like trying to make too many points, and I think I lost track, and then I didn't know if I even answered the question they asked. So it was quite a deal with talking to them. But so it should be out Monday. He said Monday or the following Monday. I'm on this press tour with all these podcasts. More are coming, trying to pump up the ETF and get people interested in that. So that's been going pretty well. Nothing spectacular, but pretty good on that. Yeah, it's been an interesting week on X. Rough week, I said, on Twitter for trend following ideology. Cutting losses short and letting profits run doesn't work anymore, according to this new paper that came out. Some people read it more carefully than I did and tweeted that it's just bogus. But my favorite line in that paper, and one of my favorite lines I've heard in quite a while, is we've found that letting losses run is a superior strategy. I mean, that's pretty funny, pretty good. I like that. I don't really know how they did their research, but it probably wasn't what I would do if I wanted to prove any of that. And with stocks, and so once again, stocks, everything works with trend following except stocks somehow, even though there's been some academic research and some back testing done by people that shows that trend following stocks works pretty well. And as I said before, we ran across periods when we did our back testing on stocks where the stocks worked so well, and this was prior to the lost decade, but the stocks worked so well we had to limit the results of the stocks because they would overly influence the systems that we were going to choose to trade because, like the stocks maybe work better with the super long-term systems, or we were just worried that we would start trading the data would just be biased and that the systems we chose would be pretty much because of the performance in the equities. So, okay, get back on my list here. CTAs are not good at trading stocks. This came from Doug from Florin Court. He didn't really say why. He did say that quants are much better. He knows quants that are so much better, so much smarter than trend following. And as I said many times, a lot of these criticisms of trading 300 markets or trading individual stocks, not using trading individual stocks, these all come from trend followers. Somehow magically, indices may work just fine, but not single stocks. And then finally, what was the third thing? Oh, I got crazily criticized, made fun of. I don't know if this guy or girl is on the spaces this morning, but he was giving me the business all week. This guy, it's no fun. Big Lips, I think that's his name. Big Lips. He was giving me the business all week. So he's not going to be, it's not going to last very long unless he becomes more of a gentleman. But he was saying that, oh, yeah, didn't like the way I chose stocks. I was just trying to have some fun with my stocks. All my positions are out there now. You can see almost all of them. The ones that I have a position in, I guess we don't put the positions on the website where we're flat, but they're all out there pretty much. And you see all my fun stocks. Dunkin' Donut is out there. Elf Beauty, that's like my best performer. Elf beauty perfume maker, seller. And so he didn't like that I was having fun choosing stocks, and it sounded like I was being very emotional and not systematic and biased. So I want to get into choosing stocks, choosing futures, bias, emotion, lack of systematic process, and we'll talk about that hopefully today. But yeah, I don't know why this guy has it out for me a little bit. I guess it's going to come with the territory. I get lulled into great experiences on Twitter/X um, because everyone that is in the room and then my friends who follow me, we have such a great tight group, and they're all really fun, and they all really we disagree, but and then one guy pops up all of a sudden. I need to not be so thin-skinned, right? Okay, I bet you Oleg is ready, and I'll bet he's happy to be here.
Yes, you are right, Jerry. You're absolutely right. I'm very happy to be here. And I'm very happy to see you, Jerry, to see you, Brian, Moritz, Richard, Bruno, Michael, and other guys I see here. Josh, by the way, Billy Grove, and Marcel, Mbala Mafia. Yes, great guy, by the way. So, I'm very happy, really. And it's so real, so sincere from the bottom from my heart every time, and because of this reason I say the same thing every time. So I went back to my hometown Novorossiysk from the tent, and so uh, uh, now I'm taking part in our transform trading ideologies discussion. This week was pretty interesting in terms of, for me, in my orange juice position, which I trade for near 2 years. I'm long orange juice from summer 2021, and so it's making new highs for me. My portfolio with orange juice, and also, it was very interesting this week. I had found strong connection while I was in the tent. I have found strong connection in the agriculture commodities field, and I have listened very interesting conversation between Jerry and Mike Melisinos. Have made more sense on my Twitter page. So, and going to make a lot of notes from the episodes with Jerry that is coming in Monday, and it's happy news for me. Very good news for me that another episode with Jerry is coming. And so it was. I have heard one of the funniest jokes maybe in recent years, that not cutting losses, but letting losses run. It's very funny joke to let losses run, because if you let losses run, you will definitely your account will be under controlled, and I think sooner or later you will lose your money. So it's a funny joke. So let's get started. And you're right, Jerry. I'm really very happy as always.
Hello, Alp. How are you doing?
Hey, Jerry. Hello, everyone. Greetings from Istanbul, Turkey. I'm on the road this week too, visiting some family. So, the podcast was very well, of course. On the TTU, and I was thinking, there was a nice, quite friendly discussion around, managed futures versus the trend following, and I happened to think about, you know. Sparkling wine industry. I'm not quite sure how much you're familiar with the sparkling wine, but there are two major brands. The champagne is one brand, and the Prosecco is the other brand. And up until 2010, Prosecco businesses were allowed to use champagne as a brand on their bottle, but from 2000 and onwards, this wasn't basically the case. So, you know. But up until that moment, it was possible. And if you look into the difference between champagne and the prosecco, the main difference is, champagne uses a historical and be it more costly method to produce that sparkling wine, and therefore it is naturally an ideologue. And prosecco, on the other hand, uses the tank method, which is more cheaper and it is easier, and hence naturally it is a pragmatic approach. So you see, almost many industries have philosophical differences around being an ideologue versus being a pragmatic approach. So and there are many people who think that the prosecco is great. So not everyone likes champagne. And one of the reviews that I was reading, it was saying that prosecco is a lot cheaper. It is lower in alcohol. There is lower in acidity, and it is and sham- you know and it is sweet, but it is not sweet enough to destroy your taste. But it is sweeter compared to the champagne. So, you know, and I thought, okay, right, I have to talk about this, the champagne versus prosecco. It's like, classic trend following versus managed features. It's just there, we are both trend followers, but one approach is more ideologue, and the other approach is more pragmatic. And then, I've looked into it, how they have managed, how prosecco businesses have been told not to use champagne as a brand. Well, so basically, the champagne businesses have come together and established an association. In the, I'm not quite sure whether the classic trend followers have an association as such. We have Michael Covell, who is the quasi association, but apart from him, I don't know whether there is any body or any association. Anyhow, the second thing is, of course, the champagne businesses have quite a lot of good cash flow, which is an aspiration at the moment for the classic trend followers compared to the managed future. So that is there. The other thing that the champagne businesses have done very well is the continuity. When this business goes from one generation to the other, there are families who have been doing it for centuries. Like in the trading space, the continuity we have. I think we have two models so far, which I call one of them is the Warren Buffett model. He's going to give the helm into one of his vice presidents, or the George Soros model. I think his son is at the helm at the moment. But the continuity is very important, because if people who are doing this sort of stuff doesn't actually involve in carefully planning the future of their businesses, of course, those businesses will not survive. So it's very important. And of course, the other thing is, timely and the resourcing. So the new fresh businesses are also coming into the champagne business, and such is the classic trend following as well. So so that is also another point that caught my eye, how champagne businesses is actually doing it even though they are using this costly method, historical method, and the bottles are more expensive. So here you go. I told the story from my angle, but when you drink the prosecco or the champagne, just remember that one of them is classic trends, the other is managed futures. Thanks a lot.
Okay, I like that. And that's pretty interesting. So I just started Googling while you were talking, and I remember having visited Bordeaux, and I come away with I think it's a good analogy before I have a different reason that I like this analogy. Because I Googled French wine rules, and they have tremendous rules. Well, I don't know, tremendous. I would say a few rules, and I don't have time to read them all, but I remember some of them when I was there. Like there is in Bordeaux, it has to be a blend of different grapes. In Bordeaux, the wine must come from. It must have a chateau name on it on the wine bottle, and the grapes must come from there. So in California, they outsource the grapes all around. You just slap a name on it. So, anyways, I think comparing Bordeaux to California wines, let's say, would be another good comparison because we have these strict rules, and most of them are no fun rules, and you can't have a profit objective. You can't got to hold on to the trade until the trend reverses. You got to take your losses. You got to take the small losses, use a stop loss. And so I think in some ways, for maybe a different reason than champagne and prosecco, it is in my mind a little bit like Bordeaux versus California red wines. We do have these rules, and I like our rules. And when I was doing a lot of initially, when we were doing a lot of research to decide what worked and how we were going to proceed with our strategy, we started coming up with a list of things we were not allowed to do, like because we prize sample size, treating the markets the same way, longs and shorts. And so I think I have that list somewhere that we almost were limited so much. We were limiting ourselves on the type of research and the type of things we would, you got to let the profits run. You can't have a profit objective, can't vol manage. And most of it, I'm sure, was built around just worshiping this idea of sample size. Where now, with Michael Harris, sample size was under attack this week as well. So this is something, too, that's interesting to talk about. And I think Richard and I have talked about it. And I don't think Richard is necessarily 1,000% in my camp. So I was feeling a little nervous this week because my total emphasis on sample size was being kind of respectfully and questioned. And simply, I think Michael or Richard would want to talk about this today. And that is that when I was taught, because we were using the same parameters and the same system on all the markets, the longs and the shorts, and we were doing that in order to maximize the sample size, the one entry, one exit, stop loss, and we would just take these trade statistics from all of the trades and not segregate the longs or the shorts or the currencies and the bonds. And because we were doing, and here comes right here. Here's what I think is not everyone agrees with. And maybe I'm the only one who still agrees with this. Because we were handling every trade the same way, we were able to say this is our sample size. However, it seems that another way of looking at this is that, well, no, that's not the sample size, because in your net of trades that you have now captured with this system, you've captured some very large fish here. And these outliers cannot be put into the same group and counted. Those outlier trades and their performance, sadly, cannot be included, or not the way Jerry keeps talking about it, they can't be included because they're too crazy. They're these outlier trades, they're fat tails of the distribution. And okay, so it's just two different ways. Well, at least two different ways. my way and everybody else's way. Good morning, Richard, or good afternoon. I like starting this a little bit early.
Yeah, that
For
was
me,
great.
yeah, I like starting
How
early
are you, Jerry?
because I'm well. Because
But
I'm old now and I get up so early that why not start at 7 a.m. Eastern time? But hopefully for my Aussie and European buddies, it's working out well too.
oh, it's working out fantastically. It's a lot earlier tonight, so I don't have to burn the midnight oil so much. But look, Jerry, I've got to admit, I loved your podcast you did with Andrew De Beer and Niels last week. I've had a chance to listen to that quite a few times now, and I must admit you did a fantastic job there. You're obviously well prepared for it because it was crystal clear, and I really liked your explanations. But look, this week I've had my head tucked into a great book that I caught the eye of from LinkedIn from one of the posts there. It's called The Primacy of Doubt by Tim Palmer. And it's talking about uncertainty in classical systems, and it's absolutely fantastic. And so it's giving when I make a statement like outliers are universal features, I like to back that up with stuff. And this book is giving me a hell of a lot to back up that statement that these outliers are universal features. They're much more frequent than we anticipate. And the particular type of system that we are examining, these financial markets, is very much like the weather and some of these other complex adaptive systems. But this particular class of systems is able to generate these significant endogenous, once again, we get the endogenous word, these endogenous basically outliers sort of arising from previous sort of predictable conditions. And what this leads to is the ability to not be able to undertake long-term forecasts. And it's not just a case of complexity here that we're talking about, because what they've found, say for instance, for weather, they've found that they can only do long-range forecasts out to about 14 days. Now, this is the forecasts to do with precise forecasts or precision forecasts where uncertainty is minimised. So there is this sort of, it's almost like a vanishing point. And what we find is that logically you would assume that, that's simply because the computers that we're using aren't powerful enough. And if we can apply a sort of a reductionary process to reduce the uncertainty through more precision, surely our forecast can get longer. And what we find with this particular class of systems is that there isn't a linear relationship. And so what happens is if you double the computer power, for instance, you halve your the next sort of forecasting period. And then if you double it again, you quarter it. And if you double it again, it's a 16th of it. So it's a sort of a non-linear decline, which comes to a limit. So, and what this is saying is that that's so interesting, is that fundamentally, even in classical deterministic systems, some forms of them, which display these fractal properties, they're exhibiting all of the characteristics whilst they're deterministic. You cannot use them to predict long-term projections. And I just find this fascinating. It's giving a lot to sort of back up some of the ideas that we're talking about. But yeah, no, I love that book. So it's Tim Palmer, and it's called The Primacy of Doubt.
Yeah, I read that. I read that too, Rich. I thought that he had categorized the weather as simply a complex. I'm splitting hairs, but simply a complex system. Whereas the financial markets, there's sort of an added veil of ignorance because it's, the individual agents actually impact the broader system. So that making it the adaptive piece, which is even it's even more absurd. That's why I find Dr. Ben Hunt's take on trying to figure out the narrative storm or whatever he's trying to do. Every human brain is a complex system, and the financial markets are a complex adaptive system. So it's just hilarious.
Look, even the weather is complex and adaptive, and the way yes. So what happens when you look at turbulent flow? You know how you talked about the collective action of agents and in the financial markets operating at all scales. What you find in turbulent flows is that these emergent structures, or these eddies or whirlpools that you often see in weather formations and in liquid viscosity studies. These eddies of different scales. So you've got large eddies, smaller eddies, smaller eddies. They're fractal in nature, and these emergent structures, or these eddies, actually create at the global scale, as opposed to the reduced scale, they actually create emergent structure which changes the trajectories of mechanics in that system. So what that means is that mostly, in science, we've often used computers on the assumption that if we can, increase the fidelity of our precision of our instruments, we can fundamentally understand at the lowest possible level how a system operates. What we find with these particular type of systems is that there is fundamental structure not only at the fundamental level, there's also fundamental structure with large scale, what they call attractor objects in that system. And so the entire properties of that system are acting as a structural scaffold to sort of interact with the trajectories of any body within that system. So there's a twofold, there's a macro and there's a micro impact of these fractal-like systems. Hence, you find that if you get a microscope and you go into a simple base system that might have a ellipsoid or a circle or a whatever structure, when you actually drill down into the microscope with these simple structures, you find that they are Euclidean in nature. At the smaller scale, they appear flat. But what you find with these particular class of systems I'm talking about is, as you drill down, you can never get that resolution of flatness. They're fractal all the way down. And this is because the emergent structure or the architecture is at all scales, and they're non-linear. And so this is creating the inability for us to be able to predict with precision in these systems over a specified time duration. You get these phases of predictability punctuated by these transition events or these significant outliers, and there are endogenous features of the system. They're not being created by exogenous factors coming into the system. It's a feature of the system itself with the macro scale and the micro scale interacting.
No, yeah, it's good. And I see what you're saying now. It's so funny though. We've known this stuff since Imperial France, Poincaré. And yet people are still trying to improve the computer systems and the like. So
I know it's because it's just so hard to conceptualize that people sort of don't want to go down that avenue. But when you do, it starts making sense. But you've got to hit it a number of times. That's why if you're reading that book, you've probably got to read it 2 or 3 times. I'm on my second read now, and I still haven't clicked with everything, but it's getting there.
Yeah, and I don't think trend following will be a saturated space precisely because of that for all of human history, frankly. Anyway.
Yeah, and this is Maurizio, by the way. Nice to be here. This is exactly why I think we can't and shouldn't make any predictions about these things, about these systems, because it's simply impossible to do. You'd be negatively surprised because whatever you forecast or foretell most likely isn't going to come to fruition. I think these outliers, they're all around us. We look for them in financial markets with our systems, but they're really everywhere. Anytime I hear my wife say, who would have thought that? It happens daily. You have
Snooki was famous,
Yeah, you have these mini surprises in your life. Everything seems to be more fat-tailed than you think. For instance, today we got school report cards here in Germany, and looking at my 2 sons, it's very fat-tailed, both in both directions, right? They have A's in sports and essentially F's in everything else. Well, I'm exaggerating, but it's kind of like there's no middle ground for these guys. It's either on or off, and a lot of things are like that, and you have to be able to cope with it and not being thrown off. You have to, build everything in such a way, I believe, that it's resilient and it can handle the volatility. This is, over time, this has become so clear, it's become so important that everything you do needs to have that resilient feature. You can't make that stuff up. You have to be able to hit the curveball. And it's also why I have a lot of, like, over the time, I mean, I don't want to criticize them too much, they're in business, but all these macro forecasters who say this is going to happen, or the S&P is going to go higher, or the S&P is going to go lower, or volatility is now too cheap and it therefore must go higher. And, look at the macroeconomics and interest rates and this, that, and the other thing, and debt. And I mean, 80 to 90% of these forecasts, they're never true. And they make stuff up. They use either very long-term horizons, so that, over a very long term, obviously everything can happen, or they don't mark to market. Like, all these economists, they never mark to market. They just, selectively recall their forecasts from the past that were bold and actually turned out to be true, and they look like superstars, but they brush the ones that, that didn't come true under the carpet, and they're most likely more than 80% of these. So when you have money at risk and skin in the game, you start to behave when you have your own money at risk, right? Not just clients' money, you start to behave in a different way, I think, in a better way as a trader. So that's that. By the way, on just real quick, 30 seconds on the Prosecco and the stuff. There, I think personally, this is just my personal opinion, the real undervalued country there is Spain. They have some fantastic cava, which is really champagne quality. It's not as sweet as the Prosecco from Italy. And what I even like more there is they have these amazing brandies, which are like cognacs, but they're like half the price. People want to pay for the cognac brand name and the champagne brand name, but Spain has really good stuff. So when you're there, or if you come across these things, I think that's very good value for money.
But Moritz, you like rules and you're German, and yet you're not into the beer game. Doesn't Germany still have beer purity laws in place? 4 ingredients only.
Yes. Yes.
500-year-old law.
Yeah, 1400 or 1492, whatever it was. Very, very old law. Still effective. It's still in place, and yeah, I like our beers here. It's just the older I get, honestly, the less I drink of it. It just fills me up. I mean, I'd like to have a nice beer, small beer, but then I usually start drinking white wine, or in the summer rosé. But 20 years ago, you could have.
And then the whiskey.
Yes, of course, but no longer 10 beers. So, yeah, like, trading wise, really interesting week for me. By the way, I'm not sure how you guys fared, but I started July positive, and then it all turned around kind of like mid-July, down 1% or so, and I'm now back up for the month. Changed the position in cotton, really nothing major there. Got kicked out of a short in gas oil, that's now flat. Equities keep on moving higher, so hey, maybe with a bit of luck, it's going to be a positive month. And I mentioned to Bruno on Twitter in a side conversation one really interesting trade that I just want to. I'm not saying anybody should put it on, but it's interesting to look at. It's a spread trade in TTF gas futures here in Europe. So TTF is Dutch gas. It is it's the gas that we mainly burn or need now here in Europe in the absence of pipeline gas from Russia, which we no longer get. It's a trade that, by the way, I had on last year and made some good money with it. It's essentially the Widowmaker spread, March versus April. So March is still a winter month and April is a summer month. So it's exactly that transition period where in March you could still have very cold weather. You could have a lot of demand for gas, whereas in April it's usually already mild. And therefore, the March price is higher than the April price. And historically it's always been like a euro or €2, something like that. But this is in the best of times. This is like when the pipeline gas is flowing. There's no geopolitical risk. There's no storage risk. Like everything is smooth sailing. Essentially, the risk premium is discounted to nothing, and then you have people come in and sell that spread, right? And if nothing happens, if the weather's stable, if the winter's warm, etc., then they make money. But if the opposite is true, amaranth, etc., then you're getting killed because that thing just moves 20x or 40x, or whatever it needs to move, right? And so, interestingly, that spread is trading at 1.2, between 1.2 and 1.5 today and yesterday. So it trades as if nothing had happened, as if the next winter is for sure going to be very mild, as if there's no geopolitical risk, that we can get all the LNG in the world, but there's no competition for LNG from other places in the world, such as, for instance, Japan. Trades like Ukraine never happened. So I think of this as a very nice, personal lottery ticket where you have a very, like the risk-reward ratio, very defined downside risk, say $2 downside risk. It's very, very, very unlikely for March to trade at a discount to April, given the winter-summer characteristics. I mean, it would have to be tropically warm in March here in Europe, but what are the odds? And so you have a downside risk of, say, $2, and you have an upside potential of $40. This is kind of like what we do with trend following trades as well. We control the risk budget. We keep these losses small, but we let the upside pop wherever it may go. And sometimes you find it in these spreads. So that's just one that caught my eye this week.
Hi guys, can I ask you something about the weather and that book that Richard mentioned? This month I'm trying to validate trend following by defending buy and hold, right? By inverting and trying to see what's good with buy and hold compared to trend following or to any other system. So I was thinking about what you said about the weather and these kind of systems, Richard, and you said that they are fractal in nature, and that for example, the nature of the system makes it, for example, that weather can't be guessed beyond 14 days. But at the same time, there is a convergence in weather, meaning that winter always falls in the same month of the year, etc., etc. And that made me think about the argument for buy and hold, because people say, well, yeah, it can go up, it can go down, but the world grows, the companies take a share of that growth, etc. Maybe sometimes it will be a small growth, sometimes it will be a big growth, but in the end, winter comes and then summer comes. So why do a complex thing if you can, by waiting and by managing your emotions and by sticking to your guns and by holding, have a return that's simple and it's cheap?
So we're not talking about climate here, we're talking about weather. So we're talking about things like cyclones, winds, gusts, turbulent flow, that sort of stuff. So the system we're dealing with is a particular class of system, which is different to a climate model system. So a climate model system is based on factors that are outside of the turbulent flow dynamics. So we're dealing with the position of the sun to the earth, the rotation of the earth, the planetary thing, the centripetal force with the rotation of the earth, all of those things. That's classed as climate, as opposed to weather, which is looking at the molecules in clouds, the different forms of eddies in the clouds, the different forms of wind gusts, the cyclones, the typhoons, those things. And so these particular class of systems are drawing on a subset of variables which are particularly robust. But common to these particular class of systems I'm talking about is not the same as, say, the planetary motion of orbital bodies, which, I read a great article from Mike looking at the three-body problem. I do agree with it in principle. I don't agree with Mike's rash sort of counter-argument to who was it, Poincare or whatever, in relation to the predictability, because I think that if for instance you have a system, if you have a formula that defines the predictability of a system, you want that formula to last over eternity. In other words, for the truth of that formula, you want it to be applicable over all time. So whilst planetary systems and things definitely do display predictable behaviour for thousands and thousands of years, which they have experimentally confirmed, there still is a level of uncertainty with it where, over the, 1,000 years duration, it will have a particular predictable nature. And then over the next 1,000 years, it's going to have a different predictable nature. So you can't actually have one formula expressing those two classes of behaviour. I see where Mike's coming from, but this is exactly what we're talking about in this particular class of systems. So the class of systems I'm talking about, there's a couple of prerequisites. One is they are time asymmetric. In other words, they're not reversible like a lot of other equations of mechanics. So these particular class of systems are things we find in the natural world, like the evolution of the planet, the evolution of the universe, the evolution of financial markets, the evolution of economies, the evolution of weather systems. They are time asymmetric. You cannot reverse the process in a symmetrical way. You've got to appreciate that there is one broad directional arrow applied to those systems. And so when you look at dissipative structures and things that form from those type of systems that are fractal-like, you see that there are classes of deterministic system which are fundamentally unpredictable. And these particular chaotic systems I'm talking about actually have a very short duration of predictability. And the key prerequisite of these type of systems is that uncertainty, the principle of uncertainty, is not equally distributed throughout the entire trajectory of that system. There are periods of time in that system's behaviour where uncertainty is much larger, and there are periods of time where uncertainty is much smaller. So there can be periods of time, quite extended periods of predictability, but depending on where you are in the trajectory of what they call a space of states of those total systems, depending on, it's not just the initial conditions that are important, but where you are in that trajectory can have broad ramifications for, if you find you get into outlier territory. And so this Tim Palmer does a lot of studies with things like hurricanes and cyclones. He invested a lot of time working in the US, looking at the trajectories of cyclones or hurricanes over in that area, and typhoons and things. Where the possible trajectory or path of those cyclones would take. And there are certain classes of cyclone which are quite predictable in nature, and there are other classes of cyclone which are very unpredictable in nature. And this is all about not just the initial conditions, but where it is on the trajectory. And it's being useful because whilst you never know the exact location of where that cyclone is going to hit, it can give forewarning about the degree of probability that a cyclone will take a particular trajectory. And they do that through these ensemble methods of forecasting, where they're not looking at single trajectories. They are looking at ensembles where they slightly change the trajectory by slightly changing the location on what they call the broad spatial state of that trajectory. It's quite complex, but very interesting.
Yeah, because I was thinking about the outliers, and outliers, when you want to trade them or take advantage or participate in them, you need like an operating system, right? You need the futures exchange, you need the economic machinery, and the economic machinery is it's in part the economy, right? It's like I'm not sure how to say this, but like the buy and hold of things. Everything has to exist for you to trade or to participate in those outliers. So in the end, the possibility that you're playing the game means that the system exists, and then why not buy and holding it? I mean, I know it's painful. I know it's not it's not very good in terms of risk return, ankle points, etc. I'm very aware, and as I said, I'm a fan of trend following, but I'm trying to make the counterpoint of it. I mean, if outliers exist, then the system has to exist itself, and why not invest on the system itself?
Yeah, my simple response. I mean, there's much more qualified people to respond, but it's just the asymmetrically damaging impact of losses versus the wins in your system. So, if you're cutting losses short, you're protecting yourself from that, asymmetrically damaging impact of losses compounding over time. So, I mean, keeping your powder dry and compounding your wealth. I know Rich is he's out there, hunting elephants and outliers and the like. But what I love about it is just the preservation of capital that, puts the gunpowder in the gun. If you're just long only, and you lose 40-50% of your nut, you're never going to break even.
That's exactly right, Woody. I mean, this joke which we were talking about today is, letting your losses run. I mean, for God's sake, in a tail region, mate, that would be the end, the risk of ruin of your entire process.
I want to weigh in on this. It wasn't Alp, Richard. It was Cordura, just FYI. So I want to weigh in on Cordura and this stock buy and hold thing. So I think we need to improve our ideologue game. We need to get more extreme on this buy and hold stuff. I'm pretty anti buy and hold, and I might be one of the few people. And Alan said yesterday during the podcast that I was dismissive. Yes, I'm very dismissive. And I sort of said, well, I know I have this personality that I can come across as dismissive, but I'm not actually coming across as much as I'm just dismissive. And so I don't really like this. I can't talk. I found it almost impossible to talk good about buy and hold. And then I also used as an excuse to Niels yesterday, the reason I come across as so negative on some of these issues is because no one else is talking negative. Like none of these, and all of these 20 SocGen CTAs, they never say, well, there's just pros and cons to dynamic position sizing. Here are the pros, and here's some of the cons. Like the cons to what? Classic trend following. I mean, you don't even have to say it. It's just so evident. It's out there. I like to say it because I want to come across as some tough guy, right? Oh, we do the hard thing, do the right thing. We take all these drawdowns. We revel in the fact that it's hard to let your profits run and give back profits and take these small losses and have a win rate less than 50%. So when no one else wants to talk about, the pros and cons of dynamic position sizing and vol management and correlation management, not the people practicing them. Oh, it's just a free lunch. You have this risk. You get rid of it. Poof, it just goes away. It doesn't get transferred anywhere. Well, not so fast. If it does get transferred, it gets transferred to having to trade larger, which is fine. We trade larger. When the S&P goes up over time, we talked about this week. When the S&P goes up over time, as it has a tendency to do since the last decade, it just goes up. And if you're trend following, you shouldn't be trend following the S&P index, but let's just say that you are. As the S&P goes up over time and it keeps making new highs, if you put any kind of trend following on that, you're likely to make less money. I mean, of course, because it came down and hit your stop, your trading stop. Then it went back to new highs, or you took a loss and it went back to new highs. So by definition, in a bull market, in any market, certainly definitely stocks, trend following by definition underperforms. It's doing trades to exit longs or with profits or with losses, and it goes back to new highs. So you have to, in the back test says, okay, over time, in order to make up for these times where nothing is going to do as well as buy and hold, you have to use leverage. So we use leverage. Everyone uses leverage. So as you refine your system, looking at the returns and the drawdowns, as you refine it in your methodology, and it includes trend with exits and stop losses, in some of these markets where buy and hold works really well, you make less money unless you leverage it up. And you can leverage it up because the drawdowns are smaller. And then you start acquiring this diversification. And then you can leverage up some more. But and so that's just exactly what they do. As they take smaller profits, because they're getting out of these trades before they turn around, they go up and make new highs again, and then they keep going. Orange juice could have massaged that trade many different times, and I think I've talked to people on podcasts who basically talked about it. And after a week or a month in the trade, they were liquidating some of the orange juice. I mean, in hindsight, it looks silly, right? But as you do this, it makes a more efficient portfolio theoretically, and then you have to just up leverage. And so the average loss that you would take, as in this trend following example in the S&P or with dynamic position sizing, your losses increase. And so this is where this dynamic position sizing, vol control, correlation management, vol management, this is what happens. You have to trade larger. It's a more efficient system. Theoretically, it's more efficient. I'm a little skeptical. Is it better? It's more parameters. That makes me nervous. Okay. So anyways, back to the S&P buy and hold. I don't really like, I think there are signs out there that it's a little wobbly because at one point in time, I think Niels and Moritz and I, a few years ago, we were discussing at some point how different countries were falling off the list where buy and hold would work. It definitely works in the U.S. It definitely hasn't worked in Japan. And I think there are other European countries, capitalist countries, where they tend to come off that list of having it work over time. And so you don't want to get to a situation, I mean, or maybe you do. I mean, maybe we're almost there where when it works in the U.S. and it doesn't work in a lot of other countries, but this is proof. I mean, I don't know. Makes me a little unsure. And then you run the research, looking at the buy and hold, where you have 4% of the stocks, this has been done numerous times, make all of the money. And they're down to 4% of the stocks. You got all these fundamental reasons, capitalism, growth, humans, population, where it's just destined. This equity premium, stocks are going to go up over time. And then it's down to 4% of the stocks. And then if you apply trend following to a basket of equities or currencies or commodities or interest rates, 90% of the markets contribute. The profits are due to 90% of the markets. And so substituting in the trend following, and then coming from trend followers, it's the trend followers who will segregate and love on trend following and espouse the wonders of trend following, then go and add it to buy and hold. I mean, this just blows me away. Someone has to be against this buy and hold, and I'm kind of against it, I think. I'm not against it necessarily, but I definitely don't want to pay any attention to it. And then adding trend following to it is so easy. And then it transforms it into something that's way more tolerable. There was a paper out that I think Rich tweeted this week, yesterday probably, was a man. I had tweeted it a few weeks ago, talking about trend following equities. And they make about the same amount of money, depending upon your leverage, and the drawdown is a lot less. So why should anyone talk about buy and hold and this equity premium and adding this superior methodology to this very vastly inferior methodology, especially coming from the trend followers? Why doesn't someone come out with currencies, commodities, and bonds, trend following, plus 150 trend following 150 stocks?
I totally agree with Jerry, because when you change the process of a trend following model, and for instance, the argument we're saying is that any form of adjustment of trades, volatility targeting, dynamic position sizing, etc., is anathema to our approach. And the reason we say that is that We use structural methods to mitigate our risk. We use our stop and our trailing stop, and we use our small bet size. These are structural methods to mitigate risk. So at the portfolio level, with our portfolios, with our equally weighted return streams, we are less concerned about correlations. But when you apply dynamic position sizing, when you apply volatility targeting and you're adjusting your positions, suddenly at the portfolio level, you've got to take correlations more seriously because, especially under leverage, you can find that particular return streams get incredibly overweight when you're adjusting your position sizes, etc. So at the portfolio level, there's an instability created through not having stops, not applying, through these non-structural methods of adjustment, these continuous styles of adjustment. At the portfolio level, the portfolio sponge, which is carrying risk, the risk is being distributed in different weights all across the portfolio. Now, this is beneficial for convergent regimes. This is where they will outclass us in these convergent predictable regimes. But in fat-tailed environments, this is where I maintain that these particular processes that are adopted by many of the CTAs, which are extracting different forms of trend than what we are particularly specialised in. We are specialising in the tails. They are specialising in trends that occur in other regions of the distribution. They are less concerned with the tails. They are tampering with the tails. They are reducing the profit potential of those tails by this form of adjustment, which is using ideas based on the extra information that they believe that is available from volatility that allows them to apply these dynamic styles of adjustment in their portfolio. Now, that's all very well and good during these predictable convergent regimes. But I think during these chaotic periods of tail regimes, suddenly we find, this is where the two-way risk occurs. They thought it was a lower risk strategy by applying these more convoluted methods of using correlations, which is a linear relationship in a portfolio as opposed to a non-linear relationship in a portfolio. And this is where I think in fat-tailed environments, these smooth equity curves produced by these particular classes of CTAs that are applying these dynamic methods, I think can come undone. And I think this is exactly what we find in these funds full of Nobel Prize winners and PhDs. They get sucked into the power of the statistics in these predictable regimes, and they forget about this class of unpredictability that occurs in tail regimes. So how do we prove that our method is better than them? I think we've got to wait and see over the course of a very, very long-term sort of live track record who wins in the end. Because if we do get into these tail regions, I am much more fond of applying our particular process in those tail regions than the process that these other methods are proposing.
Hi, guys. Hi, Jerry. Hi, Richard. Hi, everybody. I keep missing the start. I think we're starting the standard time and we keep starting earlier. So I just caught this by accident, that it started earlier. So I'm not sure if we're starting this new time regularly or this is just a couple of times, but we can talk about it. Jerry can answer that later. So what occurred to me when I was listening to Jerry and Richard, when Jerry was defending a classical trend following, and it just hit me. It just a hierarchy and a relationship thing hit me like a structure. And you guys just listen to this and tell me if there's something to it. So think about this hierarchy, loose pants hierarchy. So basically, I'm ranking now three things in the dimension of loose pants. On the top is buy and hold. On the second place is classical trend following. On third place is dynamic position sizing. And I will explain the hierarchy and why it just occurred to me that in the same way that Jerry and Richard criticize dynamic position sizing versus their classical trend following, then they used the opposite arguments to defend classical trend following against buy and hold. And the exact same buy and hold ideologues, the buy and hold ideologues could use the exact same arguments that Jerry and Richard use against dynamic position sizing. They can use that against trend following. And let me elaborate on this. So let's say there's a universe of 500 stocks or 1,000 stocks, and the buy and hold guy just puts small positions in 1,000 stocks, small positions, and he doesn't care if one of them goes to zero because they're small positions. So basically, him going to zero would be equivalent to 1,000 trades and with stop losses for Jerry and Richard. So there's 1,000 positions. He enters 1,000 positions with a small position, small enough that if one goes to zero or complete loss, it's not a problem. And as Jerry said, 4% of them will make all of the money. And he holds them for 10 years, buys 1,000 stocks, holds them for 10 years or 20 years over a long period of time. And as history has shown, 96% of them, the 96% of them will kind of break even. Maybe 500 of them will go to zero, go bankrupt. 500 will kind of tread water, do nothing. And only 4% of them will hit it out of the park and make all the profits for a buy and hold. No trading. So buy 1,000 stocks, take a look at them 20 years from now. And if you do this rolling period over history, as Jerry suggested, the statistics is that most of the money will be made in the 4% of those 1,000 trades. Well, that's exactly the same argument that Jerry makes when he makes 1,000 trades. He doesn't expect most of them to make money. He expects most of them to kind of break even, or the losses to cover the wins on the stuff. But the 4 or 5% of outliers of those trades to make all the money. So the exact same arguments that, and then Jerry comes in, hey, why are you buying and holding, which is very painful? You're holding these 1,000 stocks. Some of them are going to zero. You're watching them go down. Some of them go up a lot and they go down a lot for 20 years. You do nothing. You don't trade. It's very difficult. It's as loose pantsy as you can be because there's nothing. There's no stop losses. And you're just sitting there. You bought 1,000 positions and you're just sitting there doing nothing. And that's as loose pantsy as you can get. And now Jerry comes in and says, hey, why are you guys being masochistic about this? Why are you doing this the painful way when I can come in and do it much better, where out of the 1,000 instruments and 1,000 trades that you got in, I can make it so that 90% of them make money, not just 4. So instead of you waiting for the outliers, I'm going to smooth those outliers. I'm going to cut those outliers. I'm going to cut some of the profits out of those 4% winners, but allow much more higher percentage of the universe of the space to be profitable after 20 years. And on top of it, you will have less drawdowns and more profitability, less drawdowns, but with higher leverage. Well, aren't those the exact same arguments that Jerry uses against people who do position sizing? So the exact same argument, again, I'm repeating, and this is how the hierarchy appeared to my head. Because buy and hold, if Jerry is a loose pants ideologue, buy and hold is as loose pantsy as you can be. And if you're an outlier hunter, buy and hold is the biggest outlier hunter there is. Because you're entering 1,000 positions, you have your stop loss is 0, basically. You're accepting them to go up. Most of them go down. 4% of them make money. Those are the outliers that you're hunting over 20 years. Now, so basically, when Jerry and Richard make this argument to the buy and hold people that, hey, don't count on 4%. That's risky. Those 4% may not exist. They may not be there. They may not be in your 1,000 positions that you put. They may be in some other 1,000 positions. So you may only have one of them that makes a lot of money and you're going to make much less money. So my argument is, if you make this, then you should also accept the argument of us position sizing people that are saying the exact same thing to you. Instead of counting on the small percentage of outliers, so our pants are a little tighter. So buy and hold bigger, looser pants. You're second with less loose pants, and I'm now the dynamic position sizing that I'm saying I want to distribute profitability across even wider group of the universe of instruments and time frames. So not count on the 5 or 10 or 12% outliers, but spread it even further. So that's my argument. What do you guys think?
I disagree, absolutely, because yes, buy and hold have the loosest pants of all. No doubt about that, because there is no structural mechanism for them to get out of the trades.
And they fall down.
And they're long only. So they're long only. And what we're saying is that, all right, within our regime of trend following, where we cut losses short, which buy and hold don't do, what we're doing is, and we're trading both long and short, and we're being selective, or when we enter the particular market to trade, we are not trading the entire distribution, which a buy and hold does. And the buy and hold is trading the entire distribution, but in a long-only manner.
That's trading. Not true. Buy and hold is not trading anything. Guys buying 1,000 stocks, $10,000 each, 1,000 stocks, and he's not touching them for 20 years. He's not trading anything.
That's right, but what he's doing is he's not cutting his losses short. So he's not applying an asymmetry.
Yes,
an asymmetry
he
in
is.
the
Cutting
system.
he's cutting his losses short by the fact that every $10,000 put in a stock, when it goes to zero, it stops itself out.
No, but the assumption is, in his model, that there's a long-only bias to the markets in perpetuity. If there isn't that case, then he will be in risk of ruin before you know it, because he has no stop-loss mitigation. He has no adverse risk mitigation in his models.
Well, let me say, if there is no long bias, if there's no long bias on all markets and in all stocks, which comes from fiat money, then my point in my argument is that even classical trend following will not probably make money, because it will not adjust to the volatility, because the profits from the shorts are limited with the zero. You cannot have outliers in shorts, and you're only depending on outliers on the long side, just like the buy and hold guy is depending.
But 80% of the distribution is trading in the normal market regime. 20% is trading in what we are focused on, which is the power region. So we naturally get a higher percentage of outliers in our distribution, because we're being selective as when we are participating in the market. We're not participating at all times like a buy and hold model.
I understand there's differences. I mean, I'm asking you to analyze and comment on the similarities. Of course, the buy and hold is very different. Buy and hold long only is hugely different from trend following long and short in different markets. What I'm saying is, if the analogy that I presented with 1,000 bets, buy and hold, long only, stop loss is zero, and then let it rip on the rest, let all the losers stop themselves to zero or wherever they're going to stop themselves out, and let the other guys just let it rip, whatever it happens. Just look at it 20 years from now. And I'm not saying it will always work. There has to be a long bias. There has to be a going up bias, which in this fiat world is a pretty fair assumption to make. And my what I wanted to say with this analogy, which kind of hurt, which just occurred to me, is then if you're proposing that classical trend following, because of the lower drawdowns and because of the wider distribution of profitable markets, so instead of 4%, it's 90%, that's your pitch to the buy and hold guy, and you have much less drawdowns. Well, that's the exact same pitch the dynamic position sizing people are making to the classical trend followers. That's the only point I'm making.
Well, I think I don't think it's very logical for the drawdown. I mean, I'll combat loose pants with no pants at all. I mean, I don't think it's a good analogy that, hey, how can you be for loose pants? And then I'll come in with this buy and hold strategy that has no pants at all. And it's really no system at all. But I think it just gets back to our ace in the hole. We have this same ace in the hole all the time. And that is the sample size. You have no system. You have no sample size. And it's just this buy and hold thing. It continues to deteriorate all over the world. And we're just saying, as risk managers, and overlay it with trend following, and that has a much less likely chance of stopping working than this stupid buy and hold, and it makes more money, and it's better risk adjusted, and it makes me very nervous. Some of the things you said, I forgot what they were, but it was strong statements attributed to me, and my statements are usually more moderate, which is it makes me nervous. It makes me nervous that it's 4%. I'd rather have 90%. It makes me nervous that it's getting to where it might be U.S. concentrated. I'd rather for it to be this universal principle. And I think, once again, when the trend followers get away from a systematic approach with rules, with sample size, with trades to count, I think we're in sketchy territory. So I think that's why I'd rather do it my way, because it just seems to me to be a bit risk reward play. Overlay these stocks with a simple trend system. You have some rules. You're going to pick up these outliers. Trend following transforms all markets into positive contributors on the profit side, and of course, most markets will contribute to the diversification as well. So buy and hold is, well, we'll include gold now, because if you look at gold over history as of this recent period, now gold can get back in because it has a positive buy and hold. Now, at one point a few years ago, crypto got in, and I think bonds are still in, stocks are in, and this is just such a silly approach. I trade 300 markets, and they're all in because they all rely upon the same system, and they all are positive contributors, capturing those tails and keeping those losses small. So I don't think it's a contradiction at all that we prefer a systematic approach versus no approach. This is what your argument is. That
no risk management approach.
And you're taking this cliche, and this is the problem with that other paper, and I tweeted about this. Pull out a cliche, and then let's prove this cliche, right or wrong, loose pants, cutting losses short, and letting profits run. This is not how we do it. I've said before, we need to be systematic traders before anything. And then once we run it in the back test, we have a sample size, we have the rules that we're going to apply. We don't have a lot of parameters. We don't have a lot of extra rules in our system. Then we show the results, and we describe the system as cutting losses short, letting profits run. Loose pants. These are silly cliches and ways of unsophisticated, unscientific ways of helping people sort of see some of the characteristics of these systems. But we don't sit back and pull a cliche out of the thin air and say, "Aha, I got you on this cliche of loose pants. Now here's my idea that has no pants." Yeah, I'm not persuaded.
Yeah, I read a book called 100 Baggers that was entertaining, but yeah, I think the presumption that you can buy 1,000 stocks, there's two kind of critical assumptions you're making. One is that the magnitude of, let's call it those 4 stocks, the magnitude of those gains based on, well, an infinite confluence of factors, but you're assuming that the economic backdrop is going to be buoyant enough to have those 4 stocks make up for the magnitude of losses that you're experiencing with the rest. And I think buy and hold, even historically, you look at the negative skew in the return stream. I think you can't talk about the loose pants without talking about cutting losses, because you got to wear a belt. I think compounding and the and sort of mitigating losses, to me, that's the real beauty of the strategy. But
it's some things in life that even if they work out, it was never the correct choice. It was never the correct choice. And this is another, I think it will always work out. I have no doubt. I don't really care. I'm sure for the next 1,000 years, buy and hold in the U.S. will continue to work. I would put money on that versus the opposite for sure. It was just never the right choice. We know better. There were perfectly great alternatives that were vastly superior. They were demonstrated to be superior all the time. It was just never a good choice. Did it work? Of course it worked. I don't really care if it worked. I know better. I'm not going to go down that route. Look, give me the trend following over with the stocks, and it makes less money. Yes, I'll take it. And it has vastly inferior. It's not nearly as consistently profitable as stocks. I'll still take it. None of that is even true. It's better. It's more consistent. It has smaller drawdowns. There is not one thing you can cite. There's not even possible for a trend following system to make 8% a year with over a 50% drawdown. That's frequently happens in equities. So just like a lot of things, yes, it may work. Yes, I think it will work. Yes, I hope it does work. Yes, I don't give a damn if it works. It was never the right choice. From comparing that to a systematic approach with rules and something you can back test, no, never.
Maybe I was misunderstood. So I didn't come in to defend buy and hold here. I hope it's obvious to everybody here. I just used the analogy in the hierarchy. Of course, I'm for my approach, which is dynamic position sizing, which is number 3 on that list of loose painting. So I don't buy and hold. I don't classical trend follow. I do dynamic position sizing, and I do it systematically with rules and with everything, as Jerry says, is the advantage of classical trend following versus buy and hold. So I agree. All the arguments that Jerry that Jerry says makes classical trend following superior to buy and hold are the exact same arguments that I am making that says that dynamic position sizing is superior to classical trend following. That is my point.
Yeah, I know. And the only thing that we keep saying every single time is that the only thing we say is that it's extra rules and extra parameters. And you're like, yeah. And you and I had a discussion months ago, and you said, yeah, but I don't think that's a problem. I don't think it is. I think the sample size is fine. And I said to you, that's the answer. I have no comeback to that.
No. I said I have less parameters than you. I didn't say I have more parameters and it doesn't bother.
Right. Okay.
I have less parameters than you. And the exact same critique that you're saying that even if I had more parameters. So again, the analogy stays, it continues the more we talk. The exact same criticism that you criticize dynamic position sizing because of supposedly having more complex and having more parameters is the exact same criticism that the buy and hold guy is criticizing you.
It's not quite the same, absolutely. But, for instance, in your world, you're more interested in sharp. In your world, you're more interested in smoother equity curves. In our world, we pay less attention to sharp, and we pay less attention to the volatility of the equity curve.
Not compared to buy and hold.
So the analogy that's being painted by Absolute is that he's not actually commenting on our criticism of buy and hold. What he's saying is that the exact same argument that we're applying against buy and hold is the exact same argument he's applying for his third level of dynamic position sizing as opposed to our approach. And what I'm saying is, no, they're not quite the same, because in the approach applied by dynamic position sizing, where there's a heavier investment in the degree of correlation in portfolios, there's a heavy investigation into smoothing that equity curve, that is using volatility as a measure of risk. And we're saying, no, volatility is not the correct measure of risk, particularly in chaotic environments. Now, what we're saying is that history has presented a fairly predictable regimes over the past. We still haven't found a significant dispersion in returns between those who profess to the dynamic position sizing method versus our classic methodology. Yes, our ride is more lumpy and more volatile, but in pound for pound returns, when we look at Jerry's, Chesapeake, when we look at Mulvaney, when we look at those who we think are adopting this classic trend following approach, we're saying that we can't find any significant difference there might be differences in volatility, but there's not any significant difference in overall absolute returns when you look at the risk-adjusted performance over a very long period of time. We're saying, however, this has been in a fairly predictable market regimes. What happens in chaotic environments? And we're saying in those chaotic environments, we would suggest that the methods deployed through these more advanced techniques like dynamic position sizing might be not as powerful as the methods we deploy, which are structural in intent. They are deliberately suppressing or mitigating volatility to create this asymmetry, as opposed to relying on the portfolio level qualities such as correlations, etc., to manage risk. Because we feel in these chaotic environments, which is sort of fairly information deficient, there isn't this additional information that's going to give us any more ability to manage risk more effectively than what our classic methodology is stating. So we're saying in these tail regions, we think that we fly. And in these tail regions, we'd say that third class, that dynamic position sizing, might not fly as fast. That's what we're saying.
Okay, we have history. I mean, I was in the industry. I was there in 2008, and I was trading my strategy with dynamic position sizing on an institutional level with big size. And when I compared my performance and the performance of other, you call them managed futures funds, let's say 2007 to 2010, it was pretty chaotic period. It's 2008, global financial crisis, tons of tails, and everything going bonkers. So can you present? I don't know. You may actually have the data, but from my anecdotal observation is that I don't think that classical trend followers or people who did not do dynamic position sizing did much better 2007 to 2010, those 3-year period.
What I do have is the dispersion in returns of CTAs as opposed to classic CTAs was far greater in 2008 and in these major chaotic periods than the classic models. The classic models were much more positively correlated and less dispersed than the CTAs that are applying these more convoluted, more complex methods. That's in chaotic regimes. That's what I found through my studies of the programs that have been reported in ISG and in Nielsen Hedge.
This was another point I wanted to bring up earlier, which is I think I was making this point yesterday with Niels, is that, I just hate this idea that because Niels just keeps coming up with this same retort, which is I just don't see the difference I haven't seen any difference between dynamic position sizing CTAs and everyone else. And I try to say to him, well, it's 99.9% of the managed futures CTAs are dynamic position sizing. It's Moritz, Richard, Jerry, Mike Melisinos, and Mulvaney. And no one is comparing our performance to the SocGen 20. And it's very frustrating. Are we really? I guess we just have to sit back and wait. And it's essentially what we're saying is you guys are having too many parameters and too many different rules with this dynamic position sizing. Erroneously, according to Absolute, that's not correct somehow. Then we just have to sit and wait until you have this problem with future tails and the back test not looking like what's going to happen in the future. But I don't think you have a very strong point. I mean, maybe you could talk to this, but I just can't understand how you have a strong point that our ultimate issue with it is we think there's more rules, we think there's more parameters, we think there's more going on than one entry, one exit, and a stop loss. More, absolutely, there's more going on from one entry, one exit, and a stop loss. Explain to me how that's not true, but not in a very long explanation, but a short explanation. And then your retort is, "Oh, I'll one up you. Now you can't complain about a strategy that has no rules, so that's looser than you." And I'm like, well, I think let's all argue about things that have rules. Like, okay, one entry and one exit, and no stop loss. I've not been negative about that at all. That's less than what I do. But trying to win the argument by saying that, aha, you're against something that has no rules, that to me doesn't resonate.
Okay, so the first answer is that I agree that the 99.9 of managed futures funds that you're quoting and you're referring to I agree with you. They probably have more complex strategies than you, but I don't belong to them. I don't think I have more complex rules than either you or them. But that's a different story. Because if anybody in this group, I know that you're very particular about overfitting and complexity and stuff. For me, that has been my ideology for the last 20 plus years. The only thing I've been worried about and thinking about and waking up at night and in backtest and stuff is overfitting. So comparing complexity of strategy with the number of data, number of runs, how many times I've burned through the data. So basically, I agree. Everybody should be very careful about sample size, statistical significance, and overfitting. This is where I think 99% of success and failure in our systematic business actually comes from. The main separator between successful systematic traders and the ones who fail is the failure to understand the problem of overfitting. And it's not a trivial problem. It's not a trivial problem. I agree. And what was the... Oh, and the second question was, when you said buy and hold has no rules. Buy and hold has rules. Buy and hold has one stop and one exit. You buy 1,000 stocks, and you, by the way, I'm comparing this. This is a hypothetical buy and hold that nobody is doing. I'm not comparing this. What I'm proposing here to compare to your classical trend following is not holding S&P 500, which constantly reweights and revalues and enters new members and stuff like that, though it's closed. And when you enter S&P 500, you don't enter 1,000 stocks with equal positions. You actually enter you put most of your money in the top 10, 20 stocks at the beginning. What I'm proposing as a comparison to classical trend following is entering 1,000 stocks with a small notional amounts, $10,000, $100,000, whatever, however capital you have. So that's your entry. Your entry is you enter now, today. Your stop loss is a total loss. Your stop loss is a total loss on each of those trade, and your exit is 20 years from now or 10 years from now. So just do that. Find sets of thousands of stocks. That's a systematic strategy.
Is that the rule in this
That's
time
a rule.
rule? And is that the rule? And is that the rule you've tested?
No, I'm proposing a strategy, Jerry. This is a strategy.
Oh, okay. Yeah. So I don't know if that works, because one of the ways that buy and hold works is with the S&P algorithm that at least doesn't let all the profit go away. So you've just got this situation that you're proposing that where you just have this perpetual bull market in certain stocks. I don't know if that's true. At least in something like, well, I was thinking Enron, but Enron's not a good example. But at least in something like, let's just take Apple, for instance. And Apple continues to go up over time. But at some point in time, I assume that Apple won't continue to go up. And the S&P will take profits, take some Apple shares off the table and book those profits as it becomes less of a weight in the S&P. So at least it has some sort of profit-taking mechanism. But I would have to, this 10-year or 20-year, you'd have to sort of backtest that and see how it worked. And I don't know if I would be able to respect those conclusions as it relates to its robustness. No, but
this is based on the argument.
The future.
Okay. Yeah, I agree. This is based on your data that you said that over a certain period of time, only 4% of the stocks make most of the money. So let's say that's correct. So that's what I'm assuming.
Yeah. Okay.
So if that's correct, and I actually have run some of these tests, and results could be interesting. This is also maybe related with Josh's experiment by putting $1 in 300 stocks and just letting them rip and see what happens, which is a very interesting experiment. So what I'm proposing is a system. It has rules. It has less rules than you have. It's not S&P 500. This is something different. And what I'm contributing here is that it's a system, has stop losses. Stop losses is a total loss. When Josh loses that $1, it's a loss. He lost $1. He doesn't care. He has 350 other trades that are now worth $12, $15, and whatever. And to say Exxon and Apple, if you're holding them long enough, yeah, you enter stocks now, 1,000 stocks now. One of them becomes Apple over the first 10 years. It rips. You put $1, now it's worth $300, and it now goes down to 150, and it goes down to 50. You do nothing. It may go down back to zero, but it may not be the one. It may not be the one that after 20 years that becomes the 4% that actually make money. A new stock in the 11th year may show up that rips from $1 to $1,500, and that completely overpowers Apple. But you should be able to watch Apple go from $1 to 300 and back to 1 or 0. That's loose pants. Your loss is $1.
Exiting trades based upon holding them for a number of years doesn't sound as robust as a breakout rule to me.
Well, I guess it's possible to lose $1. I have 630 positions now. I didn't mean there to be 630, but I'm just letting a fair trend following rules-based system run. And it's great. I have big pharmacy. With Jerry, I have big beauty on Elf. I've got a handful of just a few of those 600 that are just, monsters. 200, 300%. And that's exciting. And, it's a dollar system, but it's an experiment for me to see, can I operate trend following and get all of the edge possible versus buy and hold, predictive, Kramer-based investing. Thanks.
Also, when you look into the buy and hold versus trend following, now, if we take a step back, there are certain other properties of buy and hold that doesn't make it very appealing either. One of them is, of course, the holding period. Holding period matters. 20 years versus an average 1 year in the long-term systems, long-term trend systems. This is a huge difference. I would take that 1 year every time compared to 20 years, 30 years, or 40 years, or, getting in and never selling. You're looking after, then your sons are looking after, then your, grandchildren are looking after, and then the grandchildren of your grandchildren are looking after those trades. This is huge of an exaggeration. So, one of the properties of long-term trend trading, or the ones that I am making, which are shorter term, is the holding period matters, surprisingly, against buy and hold. So that's one argument. The second argument is the long bias. A buy and hold works perfectly with US stocks, but I'm a firm believer of sample size. And when you look into Japan, and Absolute has posted this in a few tweets, so he also believes that there is no perfect sample size. It means that the long only buy and hold US stocks, there may be an occasion where US may end up with a Japan-like scenario. So I'm not as optimistic as Jerry Parker on this on the US. Maybe I'm not living in US. Maybe that might be the reason. But here you go. So that sample size matters for even US stocks. Long bias matters because the energy prices have gone off the roof in March 2022, and the trend traders were shorting those energy markets. So there's a huge advantage in taking short trades in equities, in commodities, in forex. That's a huge advantage of trend trading. So the trend trading that I see, it is non-dogmatic. So wherever there is a dogma, that's you're gonna break that dogma. Okay, this is what the establishment does, so it is true. No, no, you're gonna get over with it. You're gonna see whether what your back tests say. So it's very important. And of course, the last one is the trend following. Russell 2000. I mean, is there anything else that more, better than trend following thousands of stocks? Why don't you just, Russell 2000 is maybe, if 2000 is too many, why about trend following 1,000 stocks in US, 1,000 stocks in Europe, 1,000 stocks in Asia? That in my mind, that would be the perfect pitch. You're just going to cut the losers and gonna keep off the winners. So, really, it's not only whether there's a stop in buy and hold, Yeah, there may be a stop in buy and hold. Fine, fair enough. But the entire model, which gives you 8% returns with 50% drawdowns, and with this, you don't using shorts, your holding period sucks. You're not diversified enough because of that unshorting thing. And, I believe there's inherently trend following is better than buy and hold. Thanks a lot.
Yeah, absolute is confusing two things here. The ensemble domain of the stochastic process he's proposing, because he's not proposing strategies, he's proposing a stochastic process where you have many possibilities, billions of thousand stock samples that you can buy and hold versus the time domain approach of the trend following. Trend following operates in the time domain, price series, timing, breakouts. When you get the sampling distribution of the stochastic process he's proposing, you will get a huge standard error. You will have some people will miss the Apples and the Microsofts, and they will end up like with 2% annualized return. And some people will have good choices, but the average, the mean of the sampling distribution will be around the buy and hold with very poor risk-adjusted returns. On the other hand, the trend following method, based on the heuristic cut losses short, the cut losses, operates in the time domain. And this is what these academics miss because they don't have skin in the game. And I have written many times, you have to avoid academic research. It's for tenure credits. It has nothing to do with reality and skin in the game. I mean, when you read the abstract of that paper, Jerry posted, you immediately understand that the people have very limited experience with investments. Very limited experience because they compare buy and hold, which is an illusion based on charts, and to some timing method that cuts losses short. This is baffling to me. And, I don't even pay attention to these papers.
But Mike...
It makes me feel so much better.
Go
ahead.
Yeah. But Mike, I think it depends your point of view, whether you are your own investment manager or trying to, for example, manage other people's money, because I agree with you completely on how to be more interested in people who have skin in the game. But at the same time, those academic ideas are the ones who are raising lots and lots of assets lately. So if you're in the industry trying to compete for assets, you have to take those ideas into account. Just, at least to deny them or to say, well, I'd rather do what I do, which is what I think. I'd rather do trend following than any of the other strategies. But they are real and they are eating the world in terms of, and I don't like them, but the fact is that they get many of the new dollars for management.
Well, that's true, and the dollars are in the buy and hold, the do nothing. These are called the do nothing fund managers. They play golf all day, okay? And they have a big marketing department to convince people to put their money in buy and hold. And I wrote a paper on June 21 for Seeking Alpha, why passive buy and hold might be the graveyard of investing. You see, you have all these people, the retail investors, they enter at the top of the markets like 2007, 2000, and they exit at the bottom in panic. They have lost like 50%, and they hit their ankle point, and no one accounts for these people when they are talking about buy and hold. It's a big deception. It's a big deception, but it's easy money because they charge at 0.1%, trillions of dollars, literally. And then the poor people, they get on the top and they lose their money and their pension, the money for the pensions. It's crazy. I mean, I can't even, why? Because there are two fractions in the academic world. One wants to prove the efficient market hypothesis correct and say the only thing you can do is buy and hold, and the other is to send the money to the passive index funds. And this is crazy for me. I mean, I can understand this. The influence, I agree, Condura. They have influence, yes. But many people pay for this.
But guys, this is exactly how things should be. We can't all make 30% a year compounded. So to make that extra 25% on top of the 5% of which is money creation or productivity growth on this planet, somebody has to lose. So Michael, don't be pissed off. Just enjoy the ride.
Michael, tell us about your paper, The Trend Following Trilemma.
Oh, that's the simple paper that you cannot have a high annualized return, a low drawdown, and a high win rate at the same time. And I think most people will agree with this. As you try to lower the drawdown, you lose annualized return because you keep cutting those losses short, but you increase the win rate. And if you leave the drawdown, to grow bigger, you can have a higher win rate, but less annualized return, or you can have more annualized return, but lower win rate. And this comes from math, basically, from a few equations. So one is a simple equation that relates the win rate to the profit factor and the payoff, and the other is a simple equation from random walk that basically the drawdown depth is the inverse of the Sharpe ratio. And this is why the Sharpe ratio is important to the industry, because, like we're talking about buy and hold, after fees and expenses, the Sharpe ratio of the S&P 500, passive index fund is like 0.4 something. Then, you have to expect to have large drawdown depth. And that is the reason with time in managers, they try to increase the Sharpe ratio as much possible close to 1, because then they can leverage the strategies. These things are all known, and all those come from the trilemma that I posted. Maybe some people would disagree. Of course, with overfitting that Absolute mentioned, you can play with these numbers and these parameters, and you can have systems that have high win rate, high annualized return, and very low drawdown. But those strategies, they break down after a while when they meet the reality of the markets. This is a basic idea.
I'm trying to reconcile your results with some of my backtest results, and I'm trying to figure out, because I think we don't come to the exact same conclusions on some things. Now, I use these breakout. When I do my backtest, I do a breakout entry exit and then an ATR based stop loss. What do you use for entry and exit? I think you use an ATR stop loss, but what do you use to? Do you use a chandelier exit, moving averages, or breakouts?
Only breakouts either 100 days or 150 days, and ATR stops, and also to size the position, I use half of a percent risk on equity. That's it.
Yeah, I think that one thing I've said before, I think that I can get my win percentage pretty high. I mean, I think 40%. It kind of maxes out in the 40s or the low 40s. But that's strictly due to the size of the ATR stop. So the turtle ATR stop of two ATRs, that is not optimal because that will give you a less return, less profit, and less win rate. I don't think there's a lot going on for a two ATR stop, but so mine is larger than that, and so it kind of gets to a level where it kind of is optimized out at the 5, 6, 7 level, which seems a little high, I suppose, but it's kind of where it kind of optimizes out, but that's going to have a high in my back test to determine really the impact it's going to be on the win rate. And the loose pants breakout exit, at least no closer than 100 days lower or 100-day exit. That is not going to have much of an impact on my win rate. So I definitely agree that if you have a 100-day breakout as your exit, you're going to have the average win is going to be less than if you have a 200-day breakout exit for your profit for your trades, and so that's going to determine kind of your drawdown and your average profit. But I don't have trouble, number one, getting up to 40% by this healthy, optimized ATR loss, and that pretty much in my research is determining my my win rate, not so much my 100-day, 200-day breakout exit. That's determining my average trade and my drawdown. So I think our results are just a little bit different.
Well, I don't think they are, because we talked about this over DM in the past. It's the annualized return that makes a difference. So you have high win rate and a low drawdown, but you are below like 13% annualized return, right? So when I'm talking about high annualized return, I'm talking about like more than 12, 13%.
Right. Yeah, I'm a fiend for these systems that, from day one, it was just, every day, it was just always talked about the average, the expectation. Yeah, and you like to make fun of people who use expectancy. Yeah, I never heard that word either. So, I'm not an expert like you, but I use expectation. And the expectation per trade, back in the turtle days, the expectation per trade was 1 ATR. And that's because we used these 20-day breakouts. And so that we were doing more trades. Expectation per trade was lower, but theoretically, you could make similar money versus a longer term look back of 100, 200, and everything in between, of course. That gives you this juicy 3 ATRs, 4 ATR expectation per trade. I love that. I just love feeling, knowing that I have that big edge, and that as long as I just don't pay attention to what happens between the entry and the exit, basically the drawdown in the profitable trade, I just feel really good about using systems that have a big edge like that. And I don't have to do a lot of trading. There's so many things that happen in these markets. It doesn't really happen to me. I'm always mystified, like how at the end of the month, when I give back so much profit on some of these trades, my performance is as good or better than the medium-term trend followers. And then I look at some of these charts, and the whipsaws, the soybeans, the corn, the meal, and how these markets just can, the currencies, the dollar is going in the toilet. Now the dollar is really strong. And like all this movement with these shorter term systematic trend following approaches, they produce so many trades that, and I didn't do anything all month in some of these markets. And some people have done like 4 trades. And so, yep, at the end of the trade, when it's been a big trend, I give a lot back because I'm waiting on that 100-day low or more exit to be hit. But these little nicks, I think they just add up over time, these little small trades, trying your best to prevent this big give back on any one single trade is just so costly sometimes. And then you look at the back test and the computer says, well, if you just wait until this major breakout, you're not going to do very well on a lot of these trends, but overall, you're going to make the same amount of money. And I can't tell you how long it took me to embrace trading like this and just living with good results and just living with bad results on a trade-by-trade basis sometimes and just seeing that, oh, I really have nothing to be jealous about with the more medium term because the longer term just avoids so much noise, even though any one particular trade can be very important to me, and giving back that profit is like really no fun. But it's just embracing all the data and the long-term approach.
Well, Jerry, you are a very special case of a very experienced trader. You are, when we are talking about systems, and we also talk about you, that's two separate things. I believe nothing can match your experience.
I'm very fortunate that I've never had success doing anything discretionary, and I've always had tremendous lack of success when I didn't follow my rules. So I have nothing to lean on other than just story after story of trading too large, then not being able to follow my rules. One of the things that I came up with as well, I pulled out, was this idea that, I pulled this out. No one really commented on it, but I was trying to be negative and be funny about vol management, correlation management, and managed futures, CTAs, mismanaged futures. And one of my comments was, I think some of these extra rules and DPS, vol management, correlation management, it's evidence that you can sort of screw up trend following. You can kind of add these things in there that are so unnecessary that cut profits short, that belies the whole philosophy of you can let these profits run and it won't be held against you. The volatility is freebie, but you got to take small losses. You can do all of these suboptimal things, pretend that sharp matters. And trend following is so powerful that you can't even F it up. You're still going to be a good performer because you're going with the trend, basically, mostly. You're diversified, you have on shorts, you're probably keeping your losses small versus having a stop loss, kind of two different things, but the same impact, the same effect. And I think that's my history as well, is that sometimes I was such a basket case on trading, not that consistent, not great systems, bad ideas, overfitting, eliminating or minimizing short trades, every mistake, profit objectives, every mistake that you could possibly make, I made, and I suffered consequences from it. But at the very end, trend following and the root engine that produces all these profits. Now I'm just like, do not get in the way of this powerful trend. Do nothing. Put all of your fate with the trends in these markets and step out of the way and don't screw it up and let the markets do their thing. That's where I want to be. But for a lot of my career, somehow I made it out by making these mistakes because of the power of the trend, because of the power of the outliers. And even though I didn't catch them all, and I botched a lot of them, and sometimes my trading was unrecognizable to what it is now. I think that is what we all that's our ultimate ace in the hole. There was this one guy at CFM who Niels interviewed, and I posted his quote. It was my pinned tweet for a long time. And CFM is a very large and great company, great trend follower, CTA type, that does amazing research. And they may be the smartest group going as far as I can tell. But this one guy, his quote was something like, when you break it down, the CTAs have nothing to offer. All of their additional additions, their carry trades, their short-term trades, their pattern recognition, all of the stuff they add has no impact at all. It's all coming from trend following. And I think that's our ace in the hole. That's where we want to be. We may end all of our careers having this similar performance, as Neil sort of says, even though I don't want it to be true. I want the pure trend following to show itself as the dominant, and you don't need to do all these other things. But I do think possibly at the end of the day, the trend can be so powerful, so strong, that even with average systems and with bells and whistles that we don't need, we're still going to come out okay because we followed price and we let those trends produce all those profits.
I just want to add about volatility management and dynamic stops, trailing stops, everything along that lines. I have done a lot of testing. They add transaction cost and the complexity to the operation, the logistics, and the long-term expectation is not any different. But in the managed future space, there are some sophisticated clients, and they call the managers, why are you having so much big position in British pound, or why your position in crude oil is so low? And then you can say, oh, I do volatility management, and they stop bothering you. So I think that's the good use of those things.
The one thing they asked me yesterday on the podcast, and when I get off these podcasts, I'm just like putting out way too much information. I'm losing my train of thought. They're not complete thoughts. I'm just trying to get everything I know out there, make this overwhelming case. And then when I get off, I'm like, oh, I forgot to say some things. And one of the things they were questioning, like my lack of evolving and improving and being willing to stick with classic trend following and only just extending the look back period. Okay, true, I did add stocks and I am adding all these markets. There is a 3-year T-note future I just figured out, and I just added it because I'm a fiend when it comes to adding these markets. Seemingly, there's no reason to. I just have to do it. It's like a collection of a little. I'm like collecting Beanie Babies, but for me, I'm collecting more markets. And so, what I wanted to say was I've kind of not evolved, but I've become more different than everyone else because I haven't done anything. I've just stood still. And I've waited and I've just watched everyone else kind of evolve and change from following prices and the classic trend, letting profits run, and all those cliches. And then I was listening to a podcast yesterday from RCM, my good friends at RCM, and I was just on the RCM podcast, but I was listening to it, and then it just was a crazy talk about this evolution of getting away from following prices and adding fundamentals. And it's just continuing to go. And it's going to get further and further away from pure trend and trend only, trend following plus nothing. And I'm just not even changing at all, except adding markets and becoming more diehard with letting profits run, letting big profits turn into little profits, letting profits turn into losses, just waiting, doing nothing except relying upon this long look back and loose pants to hopefully preserve the profits in these big trends. And yet the whole world continues to get further and further away and justify people who started out as great trend followers moving further and further away.
You might find that there's a symmetry going on there, Jerry, where the two approaches, the one taken by the others and the one taken by you, whilst they appear diametrically opposed, it's a symmetrical relationship. So your choice to massively diversify with small bet sizes might be, in a symmetrical perspective, doing all of the hard yards that all of these other trend followers are trying to do with less diversified portfolios, but therefore they have to include much more additional variables into their process to accommodate that. So you might find that in these physical systems that there's a symmetry going on here. So we're getting a branching of two divergent views, which are effectively trying to achieve the same thing, but it appears that they're incredibly disparate, but maybe they're the same.
Yes, the goal is the same, but I think the robustness and the results are going to be much different. It's so cheating. I feel like I'm doing exactly what you're saying. It's such I'm so cheating. It's so much easier and so much safer just to add more markets and have more fun. And, put on go long Dunkin' Donuts and add in all these fun stocks and these fun industries. Tootsie Roll. I'm going to be long Tootsie Roll pretty soon. So I am jealous of Florin Court for their 500 markets. That podcast I listened to again. He was pretty negative on stock trading and stock index trading and stocks in general. And he kept saying that his markets, the alternative markets, were better trenders. They made more money, which I kind of doubt, and I don't really know if that's true. But I am very jealous. I wish I could trade China commodities and some of the markets that he trades, and I don't think they really put much into stocks. But that's the best I can do now to get it up to 300, is to convince myself that stocks do trend. I can find some great diversification in equities, and these outliers are present can be present in the financial markets, in the stocks in particular. So, all right, I think we are going to keep this 7 a.m. for a while, 7 a.m. Eastern. I've tried to be very, put it out there on some tweets, setting it up and then reminding people about 7 a.m. So hopefully it works for everyone on the East Coast. The older I get, I just start waking up earlier. In my labs, this one lab of mine, if I let her sleep in my bedroom, she starts whining at 5 o'clock in the morning or 5:30. She's just so beautiful. She's so cute that I have to play with her and wake up, and then I can't go back to sleep. So 7 for me is kind of late now, but hopefully it suits everybody. I know it's better for our Aussie friends, New Zealand friends. Okay. Thanks for everybody for being here. Send me some messages, send me some tweets. Save up your tweets. Listen to mine. Read mine, and so we can have a fruitful discussion every week. Everybody have a good weekend, and we'll talk